So the presentation is going to be a little bit different than what we previously done for those of you that have been part of the finance committee and have heard our presentations previously. When Wa and my colleague Neil and I came to town this summer, we talked a lot about the work that Wa and our CIO Jahara and Frank, who you all have met before, have been doing on the funds, particularly our U.S. equity funds. So we were going, we use the terminology underwriting the fund. But really what that means is, again, taking that deep dive, looking at the individual investment managers, look at the structure of the fund. We position the portfolio different from market benchmarks, and just understanding, do we want to continue to position the portfolio that way, and so forth. So Wa and I are going to spend some time in the meeting to talk a little bit about that work, because you all are invested in the U.S. equity fund. I know when we met in August, couldn't really share too much in the specifics because it's still, the work was being done. Nothing was voted on by the investment committee and brought to our board or fiduciary committee, regarding changes that were being made, fund positioning. Well, all of that has been approved and implemented. And Wa and I want to spend some time kind of talking through that and obviously answer any questions that you may have regarding that work that is being done. Again, the first few slides in the presentation you can see is just kind of updates. I like to highlight any of the information that we distribute and disseminate to our institutional partners, again, in hopes that Dustin and now with Rachel on board can share that information with your investors to keep them up to speed. But kind of launching in on this slide, it's really an overview of what's been done. And we're going to go in deeper on the following slides. So you see the first one, it's equity fund enhancements. I know when Wa came and we talked about this even at the last meeting, is we talked about how in our U.S. equity fund, we had different passive strategies. We had like a Russell 2500 value, a Russell top 200, a Russell 1000 value, etc. So what we did, Wa and her team, was do some analysis about consolidating all of that passive into one passive strategy. And that was done. Well, when was that done exactly in the fourth quarter?
I think that was done in November. That was the first step in our process. And I think it's, beyond just consolidating, making it more efficient. I think we really want to think about the research that we've done to portfolio construction, where is passive, the most efficient, and that's in the large cap space. But as we look at our passive strategies, we had small cap, we had value, we had growth, and that didn't align with our view that, if you're going to have a U.S. equity portfolio, large cap should be passive. And so that's how we consolidated all the different, I think we had 5 or 6 different passive portfolios within USEF. We consolidated into one large cap passive strategy, and we did that transition first because it was the easiest thing for us to do. Even the enhancements that are listed here aren't all the enhancements that we have. There's still some that are being implemented as we speak, but we decided that we were going to do what we could to help improve the fund structure as soon as we could. And so the passive sleeves being combined were the first thing that happened, I believe, in November, Karen.
Yeah, great. And then we'll talk about the manager changes. Also, one thing that I didn't know in the last meeting, and Frank actually corrected me following, is that we moved the private real estate out of the U.S. equity fund, where the U.S. equity fund exposure and also in the international equity fund is only going to be private markets in terms of alternatives. So there's no more private real estate that is in that fund. And that was moved out at the beginning of this year, correct?
January 2nd. So if you look at your statements, you might still see that 3.5% allocation to private real estate, but is now out of the portfolio and it's in our special opportunities fund.
Yeah. And then the middle one, not really applicable to the foundation anymore, but our multiple asset fund, we also adjusted the targets within the fund. We lowered international from 30% to 25%, increased the U.S. equity fund, and then lowered the inflation protection fund from 10% to 5%, and then did very similarly then increase the fixed income portfolio. Again, this is only the targets. We're still working on positioning the fund aligned with the new targets. Also, one thing that we did with the multiple asset fund, and while maybe I'll turn over to you about the GART, typically it was this prescribed, we're always going to have 35% US equities and we're never going to move from it. Maybe talk a little bit about how we're adjusting. I refer to it as the guardrails, but it's more the target allocation.
Yeah, it is. I think when we think about the target, it makes sense to be aligned with what the market gives us. So when we look at what the market allocation is between US, non-US, or fixed income, we want to make sure that our fund represented what the market opportunity is, and that we weren't making these long-term bets against the market in our fund. But we also realize that we can't take advantage of some of the short-term movements and some of the momentum in the market. But at the same time, we don't want that to get away from us. So we instituted guardrails around each of our target allocations. And that just really forces us to be a little bit more deliberate, a little bit more disciplined in how our fund is structured. So if something happens in a fund, if we're overweight US or non-US, it's because we want to be, not because it just happened. And so I think it's just making us a little bit more aware and making sure that we're not taking unintended risk within our funds. And so that's why we have the guardrails, and it's something that we look at very closely. We don't want to just, I believe like in the past, we just had these targets and we just kind of let it go where it went. And I think we want to be a little bit more intentional about the weights in our fund.
Yeah, thanks, Swa. And then the
How
final
wide are those?
Oh.
How wide are the guardrails? Like how broad, how much do you shift?
I believe it's about 10% on each year.
Okay. Thank you.
And then on the product development side, we talked at the last meeting regarding we launched the International Equity Index Fund. This fund is, it does track the MSCI World ex-US, correct me, because it's not the ACWI, it's the World. And it doesn't, which means how it's different from the index we use for the International Equity Fund, which is our primarily active product, is it does not include emerging markets. So the index fund does not have emerging markets. The other primary active product does have emerging markets. So just want to kind of call out the differences there between the two. I know there was not an appetite at the time to shift into the index portfolio, but just kind of keep it on the radar that it is an option for you all if we want to kind of go down that road and talk about it. Well, I'm going to turn it over to you because I know we talked a lot. The first focus of a lot of the, first of all, we're always looking at the fund. So I don't want to think that we're not paying attention to other stuff. We're only focusing on this. We're constantly, even our fixed income fund that, has historically and continues to outperform the benchmark. We're always looking at the portfolio, positioning the managers, doing a lot of that due diligence, ongoing due diligence. But we did take that closer lens, that microscope, and look at our U.S. equity fund. So maybe, before we kind of dig into the changes specifically, talk about why we did that.
Well, I think, Karen, like when I first started, one of the things I instituted is that making sure that we look at each of our funds twice a year. We don't expect to change our funds twice a year, but we want to make sure that everything that's in the funds is how we want it to be. And USEF was the first one we looked at, just because it's our biggest fund on the equity side. We have so many clients, and the performance was disappointing, and a lot of it was due to the way it was, I think, constructed, and there wasn't the guardrails that Karen and I talked about earlier. And so that was the first one we really took a deep dive in. So we looked at all the managers, and we didn't decide on any changes to the fund until we had made sure that we looked at how the fund was constructed, looked at every single manager that was in the fund to really understand what was going on. And so as part of that, we were also doing research on what we thought was the right way to approach fund construction. Some of it is to, focus on alpha as a way to generate returns rather than some of these static biases that were built into the fund. I think we wanted to be a little bit more nimble, a little bit more in tune with what the market was doing. And we also looked at the passive versus active decision. And I think we talked about that with the consolidation of large cap or the passive sleeves within USEF. So we looked at from different angles, and then we started making changes or recommendations to the fund. We want to reduce some of the factor risk, focus more on the alpha generation, focus alpha on the parts of the market where it made more sense, and go passive where it made more sense. And so that's sort of the first step that we did. And I think we get to sort of the active and passive. That was a thanks, thanks, Karen. Oh, but yeah, so the part of the passive piece is that there are certain areas of the market that it's very difficult to outperform the benchmark. And I think our research has shown that there aren't very many large cap active managers that can outperform the benchmark in the US equity markets. And so we took a look at our large cap managers and, are we adding value in large cap? And we really weren't. And so we made a decision there to maybe have a little bit more passive in US large cap. And that's sort of the next step. You haven't seen that in what we've done so far, but we focus on the alpha part of this and looking at the concentrated managers. I think you've heard Johara talk about what we think what makes sense in equity management, which is the concentrated managers, having high active share, high conviction. The thing that I like to say is like the only way to beat the benchmark is to be different from the benchmark. And so that's what we focused on with some of our managers. Like once we decided to consolidate passive, we looked at all our managers and we made some changes to the managers there. And I think you'll see in the next slide, we added 3 managers and we terminated 4. And the new managers that we have are, Arrow Street, which is an all cap core strategy. They are quantitative, but they're not enhanced index. So when you think of a quantitative manager, sometimes you think that they're low risk and they're not going to add much alpha. Arrow Street's a little bit different. They are quantitative, but they fall very much squarely in the active camp. They are taking, position sizes are very different from the benchmark, and they use their, proprietary models to add value, to add alpha. They are one of the few managers that in the quantitative space, I think are really differentiated. They really do have a fundamental approach, and that, they're looking first at what they think drives returns, not looking for mathematical relationships on what has happened in the past. So they really are like most fundamental managers, and that they're looking for how value is going to be created through the way that a company manages its business. So that's Arrow Street. Axiom is another manager that is a very concentrated global growth strategy, and they are more focused on, I think, technology and higher growth companies. And we decided to add a global strategy in there because they are, they do best with the widest opportunity set. Right? So Axiom is going to be a little bit more active across the globe. They're just taking the entire market capitalization of all the equity in the world and just making sure that they're selecting the best stocks within it. So for them, they benefit by having the broadest opportunity set. And Voss is a smaller, it's a smaller shop focused on smaller and middle and mid cap stocks. And they are more value biased. They like to take a contrarian approach. They're looking for certain events to help drive the returns to their stocks. And they focus on, I think, what they call special situations. So they're both Axiom and Voss are going to be very different from the benchmark. And that's what we term our opportunistic manager. As we talk about the next step in the evolution of USEF, we're going to talk about building blocks. And so we see Axiom and Voss as the managers that provide us something beyond the market beta or sort of market-like returns. So for us, those are alpha generators in the portfolio. They're not going to track the movements of the markets, the U.S. equity market, because they're so concentrated, so focused that they're very different from the benchmark.
And I know while we really don't want to focus on near-term performance, and again, this transition really went through the latter part of the fourth quarter. I mean, we hired a transition manager. We knew the managers that we were going to replace. We wanted to minimize any time out of the market, any transaction costs, or anything that would be the fund would experience. And just due to our size, we're able to bring in a transition manager like BlackRock to kind of help us with the trading and then funding the new accounts. And so as of really January 2nd, I mean, this is when the new managers were fully implemented into the portfolio. The private real estate was moved out of the fund. So everything that's really captured here in the report is kind of through that transition period, like when you look at the allocation slides and so forth. So when we meet in the first quarter is when we'll get a good view of kind of where the portfolio positioning is, but we'll talk about it today. But I know we never want to focus on near-term performance, and I hate focusing on near-term performance, but like, how has the changes done in the fund so far this year?
Karen, I've been following the daily returns on this since we've did the transition, and I'm one of the people that do not focus on short term. But year to date through yesterday, I believe USEF is almost 100 basis points above benchmark,
which is the Russell 3000. So we kept the benchmark there. And then maybe just spend a little time and talk about, because we've had Brown and Zevenbergen in the portfolio since 1994. I know Tesla, we really, our investors really benefited from their early investments in like Tesla, Netflix, and Amazon. I know in the latter years, one thing I can say about Zevenbergen, and then I'll turn it over to you, Wah, is, they would, when they hit it out of the park, it was like they hit it out of the park. It was like 56%, over the benchmark. But when they didn't hit it out of the park, it was 56% under the benchmark. So it was really, the amount of risk this particular manager had in the portfolio, and I know that's quite a lot of what the team looked at when they looked at these firms. And I know too, also decision making, what's the internal decision making process of picking names and so forth. But because I know we talked a lot historically, we've talked about Zevenbergen and the partnership and how well they've done, but it was really taking a new lens at the portfolio. So I'll turn it over to you because I know you were really close to this.
Yeah, so I'll start with Zevenbergen, and Karen, you're right. It's Zevenbergen. Their return pattern is going to be when they do well, they really do well. And when they don't, they're either top or bottom. That's how they are. And it's a return pattern that I'm actually comfortable with for a strategy like what Zevenbergen has, because over the long term, we expect that, that sort of smooths out a little bit to outperformance. But one of the things that was really evident when we met with Zevenbergen is that decision making and you really have to trust the portfolio managers and how they make decisions in order to survive that kind of volatility in returns. And Nancy Zevenbergen, the founder of the firm, that's the person we had the confidence and conviction in. But as firms evolve and grow, Nancy's looking at retiring in the near term, and we look at her team behind her who are going to take her this portfolio over. We just didn't get the same sense of confidence in them. I think one of the things that really hit home to me is when I think one of the PMs like, well, Nancy told us we can't sell that, or, and to me, I'm like, well, if we're trusting you to make decisions, are you always going to have Nancy there to tell you what to do? And so I think that was a big concern to me. And I wasn't comfortable putting that type of strategy in the hands of people that I didn't know how they made decisions, couldn't trust how they made decisions. So for me, our team, when we met with them, it just didn't feel like they could really continue on with the same type of strategy that we had conviction and confidence in previously. And so that led to our decision to terminate Zevenbergen, which
And my
is,
understanding was they actually were outperforming in 2025.
yes, they were.
Yeah, so they were actually like top perform. They're in their upcycle.
Yeah, yeah.
And when we got out of them. So again, it's not purely based on performance. There's other factors. So I just wanted to add that I didn't want everyone to think these managers were in the bottom decile and we were terminating them, that it was really, it's a thoughtful process.
And all our decisions and managers are our expectations for what they will do in the future. Because, we can't change what they've done in the past. We can only have conviction in what we think they will do going forward. And with Zevenbergen, we just didn't feel that the team behind Nancy had the same skills and conviction level that she had. And we lost conviction in Zevenbergen. And then with Brown, that's another firm that was difficult for me to make the decision to terminate, because if their process and the way they manage portfolios, it really hasn't changed, and they are very disciplined to that. But one of the things with their underperformance is that they've lost a lot of assets, and I think they lost something like to about $1 billion in their small cap portfolio, which is significant. And we were just concerned that, the firm wouldn't be able to survive going forward, and that, we would be, at the bottom of the line trying to get our money out of the fund. And so there's just a lot of firm level risk. And I think with that risk in the firm, they were starting to take a look at their investment process that we had conviction in. I think they were making changes that we didn't think were really aligned with how they've managed a fund for years and years, and that we had grown to have conviction in. So that was a very difficult one for us to do, but we just felt that there was just too much risk at the firm level, and we just couldn't continue with them.
And one thing I'll add too, so we invested in Brown in 1994. We were one of their seed investors in this strategy. So we were one of the original investors. Brown really did well in the portfolio when I first joined Wespath in 2013, 2012. They were an early investor in Cologuard, in the company that made the at-home colon cancer test. So that particular stock did really well in their portfolio, and the focus that they had. So, and
Erin,
yeah.
can you maybe speak to, and maybe this might fit later when we talk about the equity fund details of its performance, but how do you perceive AI, creeping into investing or fund management or some of this work?
That's a great question, because AI has been the topic of conversation, obviously, internally. So I'll let you, because I know the team's been working on it, and particularly with these managers.
Right. So if we're talking about the AI exposure we have in the fund, or how we might use AI in our fund management process. On the second point, we're still working on that. We're trying to see how we can increase our efficiencies through the use of AI, but that, I think that's more of a firm-wide initiative that we're a part of. But in terms of the AI exposure in our fund, I think if you look at it, we are underweight to the Mag 7, what everyone seems to term as AI. But we took a little deeper look at our fund, and our AI exposure is about in line with what the market or what the index has. But our AI exposure is more downstream. Some of the smaller companies are the beneficiaries of AI, or just other players beyond the Mag 7, not the hyperscalers. And we think that where we're positioned in the AI market is probably appropriate. Right now, all you see, the winners of AI right now are in the Mag 7, but AI is so new and the technology is so new that the winners and losers haven't really been determined yet. And there's a view in the market that it's going to expand beyond the Mag 7. And you saw the performance in 2025. I think out of those Mag 7, there were only 2 that outperform the Russell 3000. So we think that it's starting. We're starting to see some of that, where the winners in AI are going to go beyond what the Mag 7 are. And so we are comfortable with where our portfolio is in terms of its AI exposure. We're not underweight AI. We have exposure just in different parts, in different sectors and different market caps. So AI is far reaching, and it's going to go beyond some of the hyperscalers that you see in the Mag 7.
Can I ask a question about the allocation new managers?
Mhm.
We have time?
Yeah.
So I'm certainly positive on adding a global manager. I believe in those type of managers that can go anywhere. But what I guess going forward, some of our clients may ask, well, how much international non-U.S. will end up in the U.S. portfolio? Is there a ballpark percent that we may end up with?
So we do have limits on how much we can have in sort of non-U.S. stocks. At the fund level, that's 20%. But in terms of Axiom, we have a 5% allocation to Axiom. And a lot of these other managers, even though they're U.S. equity, some will have some position in non-U.S. names, but they're all minimal. And we don't expect it to get to 20%, but there is a hard limit on non-U.S. equity names in the portfolio.
So Axiom at 5% of the portfolio, if they were all non-U.S., 5% would be all we would have from that. And if they're 50-50, it'd be 2.5, for example. Okay, thank you.
Yeah, and like Zevenbergen, I remember they owned like Mercado Libre, and so there is some U.S. managers that we had previously that did have some non-U.S. names. It's not like emerging markets or anything like that, but sometimes they will. I think one of them was like a Canadian, or maybe Mercado Libre is like a Canadian company that they had in the portfolio.
And I think Voss will allocate, small percentages to Canadian too.
And I think I'm just going to kind of jump ahead right here. The good thing is about your Kansas equity fund, this is a global equity portfolio. So when Dustin and team are selling it or highlighting it, it does have an allocation to international equity. So it's not as though it'd be, oh my gosh, here's this pure US equity product that now has some international names to it. So, that's the good thing, is that your equity product is considered global in your offering. Maybe while just a 1 minute, I'd talk about Wellington and impacts, and then we'll talk about your accounts.
With Wellington, they had a change of portfolio managers, and we just felt that with them, they had 2 PMs, and I think 1 PM leans like a certain way, one the other way. And what happened was like 1 PM's portfolio was underperforming, so they let him go, and then they kind of flipped completely to the other approach. And we just felt that there wasn't a lot of risk management in that is like, you have to be a little bit more balanced in how you approach it. Like, we were just afraid that going forward, they were just getting whipsawed. They would go one approach, other approach, whichever one was working. And that's not an approach that we expect out of Wellington. They seem like, Wellington is a little bit more thoughtful in how they manage these things. And that to us was not expected. It wasn't something that we're comfortable with. And so we decided to terminate Wellington from that one. Impacts, this was a sustainability focused product,
like low carbon.
Yeah. And so we were looking at how it fit within the fund, but also at the same time, the firm was going through a lot of change, and there were some significant changes to the team. So at that point, we were just uncomfortable with the strategy and with the firm, and we made the decision to terminate this out of USEF and IEF.
Are there any questions before we talk about your account performance? Is there any questions about the work that was done? As I mentioned, we'll talk about the allocation slides, but those are pretty much dated because it's as of 12/31. We run the allocation reports, and a lot of these changes happened at the beginning of the year. So we won't spend too much time on them, but we'll kind of talk about where the numbers kind of end up. But I did want to devote a little bit of time to this because it was a big focus of ours. It was some big changes to the U.S. equity fund, which is in your biggest portfolio, your balance fund and your equity fund. So I did want to make sure that we devoted ample time to the subject so you all can ask questions.
Karen, Dennis put a question in the chat. I think it's in everybody's chat. What considerations are being given to the current instability within the federal government? It seems that actions being taken could pose significant threats to the overall global economic order. When I see other governments dumping U.S. treasuries and the ever-changing tariff battles leading to disruption in global supply chains, I get concerned. In what ways is that impacting your overall strategy, or maybe should be impacting our considerations?
On that point, this is something that we do, like we're in consistent contact, very constant contact with our managers. And it's a question that we pose to them. How do they manage the risk? I think for most of the managers, they see their holdings as long-term, and they try to, quantify some of the risks that are associated with the instability in the government to their holdings, whether it's on the equity side or the fixed income side. I think we see that a little bit more on the fixed income side, where some of the actions are being taken. I believe most of our managers are underweight treasuries, and I think even our fund at our fund level, we have an overweight to high yield, we have an overweight to emerging markets debt, and we do have an underweight to treasuries. And even then, most of our managers, most are underweight some of the longer term treasuries because they're concerned that with all the fiscal policies taking place, that there's going to be a oversupply on the long end of the curve. So they're not seeing the opportunities there. They're probably focused on the shorter end of the yield curve. They're focused on high quality corporate debt and other high quality credits. So I think it's our investment managers, especially in the fixed income side, they're so risk aware and they understand more the macro issues that are occurring. And we talk to them quite a bit, and they're the ones that are positioning their portfolios to guard against some of the risks that we see with not just our government, but I think other governments around the world that are also spending quite a bit on some of their, I think, defense, especially like in Germany. So those are big considerations in how our managers think about their positioning.
Yeah, and that's the benefit. Our fixed income funds 100% actively managed. So it allows our managers to kind of make those changes to the portfolio based on what they, and position it how they feel is going to outperform the market. Also, the fund has 11% allocation to non-dollar denominated bonds. So with the dollar decline this year, those strategies actually, or I shouldn't say this year, last year, I keep saying that, in 2025, those strategies did, our largest contributors to the fixed income fund performance was emerging market debt and developed market debt. That's in the fund.
Yeah.
Thanks for the question. Okay, so I'm gonna, if I'm going the right way, I'm not, I never know which way to scroll. So now we're gonna dig in and talk about the Kansas portfolio, specifically highlighted the changes, talk about your fund positioning, and then we'll talk about performance drivers and how the fund currently is constructed. So you ended the year with a market value of over 76.7 million. Again, the increase in value was obviously bolstered by equities and bonds. Had a great year despite a lot of that volatility that we experienced, especially at the beginning of the year. In the portfolio, which it's really easy to forget just really what a volatile year 2025 was, considering the markets ended in such positive territory. Looking at your balance fund, this is your largest account with Wespath. It's a little over $50 million. Historically, when you all first hired Wespath, this was invested in our multiple asset fund. it maintained that 65% equity, 35% fixed income. You've maintained that 65-35 allocation, but you removed the inflation protection fund, and then you added in the U.S. equity index fund, and then lowered the international. The international in the multiple asset fund was 30%, and you lowered it to 20% in the portfolio. You can see the net of all fee performance. Again, this is net of all fees that we are reporting at versus the balanced fund benchmark. The primary detractor for the year to date has been the performance of the U.S. equity fund and also the international equity fund. The underweight to the mega cap, overweight to small and mid cap was a detractor in 2025. And then in the international equity fund, it primarily was stock selection by the active managers. Also, the fund has an unintended value, more tilt towards value. Again, it's based on the stock selection of the underlying active managers. And again, a lot of the work that Juan team are doing this year is focusing on the international equity fund, very similarly to what we did in the U.S. equity fund. And again, looking at the underlying managers and strategies that are in there for that. Looking at your fixed income portfolio, we highlighted that a little bit. The fund is 100% actively managed. It does have an underweight to U.S. government and treasury bonds in lieu of having an overweight to high yield bonds, and then also those allocation to emerging markets and developed market bonds, as well as our positive social purpose lending program. This fund has outperformed across all time periods, net of all fees, and it's primarily been driven by the issue selection by our active strategies and having the positioning of overweighting high yield bonds, as high yield bonds has been a contributor, one of the top performing fixed income asset classes for quite a few years now. And the fund has always had that, or historically has had that overweight to high yield bonds. And you can see the market value is just a little bit over 9.5 million. This is the equity fund. We touched on this a little bit earlier. It's a global equity portfolio, which has allocations to U.S. and non-U.S. You can see it's 30% to the international fund, again, our primarily active product. And then the rest is broken out between the U.S. equity fund and the index fund. Very similar to the balanced portfolio. What's been one of the detractors has been the small and mid cap overweight and corresponding underweight to the megas, and then also stock selection in the international equity fund. One thing I do want to highlight is I know when we did the analysis of the balanced fund and also the equity fund, the target return that we were targeting for the balanced portfolio was around 7%. I think maybe even 6.8, 6.9%. And the fund has performed aligned with that long-term expected return of what we had expected it to return. And very similarly of the equity portfolio as well. Again, when we do a lot of this analysis, it's understanding not only the returns, but also the risk that is also involved in the portfolio. And then also Dustin makes available to his investors is the U.S. equity index fund. I mean, this is an opportunity for investors if they want just a full passive portfolio, or if he has investors that want the balanced portfolio, but wants a little bit more U.S., they can invest in the balanced fund and then also have an allocation to the U.S. equity index portfolio. This tracks the Russell 3000, so it's a broad basket of U.S. stocks. Primarily, the difference between the equity index fund and the benchmark is going to be two things. One, fees. The fees that are charged in the equity fund. Benchmark does not have fees that are removed. And then also our ethical exclusions. So this portfolio does not invest in alcohol, tobacco, gambling, adult entertainment, and private prison. So if, let's say, alcoholic beverage companies do well or defense companies do well, not owning those in this portfolio, but owning it in the benchmark could be a modest detractor. But again, we believe over the long term that those ethical exclusions neither help nor hurt the long-term performance of the fund. And you can see the funds performed relatively in line with that benchmark. And since you opened this account in Valentine's Day in 2023, it's performed, typically the differentiator here is the fees that are paid in the portfolio, because the fees are about 23 basis points. And then the short-term fund, this is part of the overall Kansas short-term investment portfolio. And it's about $5.6 million. And you can see it's performed relatively in line with the benchmark, which is exactly what we would expect for this portfolio to do, which is really comparable to 90-day T-bills, and hopefully get a little bit more returns than 90-day T-bills. But that's the benchmark that's used. This is your financial reconciliation. It looks at your beginning value, it looks at your ending value, and then it looks at any contributions or withdrawals. The withdrawals is not just money leaving the portfolio. It does take into account the rebalancing that the foundation does when they try to bring the portfolio back in line, there was a few rebalances done, particularly in the balanced fund. So this isn't money leaving the portfolio. It's purely has included the rebalancing, but really this capital appreciation, depreciation. So outside of any contributions and withdrawals, you've made a little under $9 million purely on all of your investments.
We had some sizable withdrawals also, though, that are in that $11 million. So this is actually pretty remarkable to see that type of growth. The fund balance overall has grown despite the substantial withdrawals that came out.
Yeah, thanks, Melinda, for adding that.
Dustin, I wonder if you should speak to the large withdrawal for the sake of the two new members of the committee.
Yeah, so actually it was a little bit in 2024 and then the remainder in 2025. What had been our largest account with Ember Hope Youthville, they pulled those funds largely for a project that they were doing in the Wichita area. They got the state contract for foster care servicing and had some construction, and then their lender wanted money kind of with them in-house, and so a little over $10 million went out, half in 2024 and the remainder. It was like 5.6 million maybe was the balance that came out from that one larger partner. So that's a big part of that.
Yeah, and unfortunately, we see that a lot with a lot of nonprofits when they're when they're doing construction, or they need a line of credit or something, as it becomes less and less that the federal government, that they may be receiving from the federal government or the state government. And if they have to go to like local banks or credit unions to secure funding, oftentimes it's unfortunate, but they do require that they keep the remaining balance on hold. And we've seen that a few times in the last few years where it's like, hey, we're happy with you, but unfortunately, in order for us to secure funding, we have to move our assets to the bank or the credit union to get that. So it is unfortunate that that's just, and I feel like it's primarily with nonprofits just because of the ebbs and flows of the funding that they receive from the government. So they just want to secure any money they get. But thanks for that update. Any questions? I do want to pause here to see if there's any questions about the performance. Again, we're disappointed in the U.S. equity fund performance and international equity fund performance. The team has focused so much of their time on these portfolios and constructing them for the long term based on where we believe long-term positioning is going to benefit our investors. And I know it's near term, but the changes have proved to do well in this short time period that we've been tracking the changes that have occurred. And again, we are focusing the same amount of efforts on the International Equity Fund, and we'll make sure throughout the course of this year to provide you updates on that work that is being done in that portfolio. This is Richard's chart. That's what we refer to it internally, is Richard's chart. This is just the 5-year standard deviation versus the returns. You can see, I'm not going to go through this, but just kind of call out what is shown on this slide for those of you to kind of take it back and look at it. So these positive numbers, the plus signs, those are the Kansas portfolios. And again, it's the 5-year standard returns and standard deviations. And then the circles and the squares and the diamonds are market benchmarks that you can see here. So again, this is a chart that we update and just want to make sure that we include in the portfolio. Here is the strategy performance, and again, it's net of fees. I talked a little bit about this as I was going through each of the funds. You have the strategy bolded on the slide, and then the benchmark directly below it, not bolded, that you can see. Again, primarily in the U.S. equity fund, as I mentioned, it's been that small and mid cap underweight and or overweight and corresponding underweight to mega caps. And again, the portfolio, when we land on that slide, we'll talk a little bit about how it has changed, these allocations, and how it continues to change in the kind of moving forward in the portfolio. International equity strategy, one of the things that currently it's about 20% passively managed, 80% active. Again, some of that work that Wah and her team are doing is how much passive do we want in the international equity fund? Where do we want to be passive in this portfolio? So currently it's 20%. Again, we could see that increase, we could see it decrease as a lot of this work that we are doing in the portfolio. And again, it's purely been a stock selection story in the international equity fund. We do have some modest allocations to private markets, which again, those will detract when we have strong public markets, especially like we saw in 2025. I think kind of heading into this year, as we recall, new administration, a lot of the administration touting was tariffs on in the global economy. And then looking at that is, automatically thinking in your mind, well, that's going to impact international equities likely the most. And sure enough, we were all wrong because international equities performed really well in 2025. You can see this here. Our fund was up 26%. Benchmark was up 31%. And it's, kind of more than doubled some of the U.S. strategies that you can see. So again, we are, looking at that portfolio and again, positioning it for the long term. But it does not have any really strategic biases. It's not as though we're really overweight in China and India or so forth. So really taking a closer look at the fund. And then the fixed income strategy, again, 100% active. It's primarily about half of the fund is managed by PIMCO. It's a core plus strategy PIMCO manages for us. So they have, it's a pretty diversified, allocation where they can really position the portfolio where they believe is going to outperform their benchmark. And then we also have, which I like to refer to them as core satellite strategies that support this, which is overweight high yield, emerging market debt, global bonds, and our positive social purpose lending program. And all of those really contributed to an overweight high yield. And all of those really contributed to the outperformance of this portfolio. And then the short-term fund here at the bottom.
Just a quick note here. Can you guys see me, or is it just a gray screen?
It's a computer. It looks like a little mini computer.
Yeah, I have no idea what it is. So sorry, I'll see if I can play with it. But quick note, Karen, since you brought it up, but I just thought I would throw in how much I dislike the fact that we have any private equity, credit, real estate inside the portfolio. It's illiquid, it's expensive, and it's starting to show publicly cracks. Blackstone wrote down 20%. They announced it Friday, well after the market closed, but they wrote down 20% on one of their positions. It just is very concerning to me. And I know it's a small position. We've talked about it in the past, but since you brought it up, I thought I'd throw that out there since it's New Year to make sure everybody knows how I feel about that on the team.
Yeah, one thing, Sean, I don't know if you were here when we mentioned it. We actually moved out in January 2nd. We moved out the private real estate from the U.S. and international equity funds. So the private real estate is no longer part of the portfolio. And I did highlight, since it was done at the beginning of January, you still see the allocation here. But it was moved out. We do still have the private market exposure in the fund. And then, if you want to comment about private credit and the other diversifying strategies.
And thanks for pointing that out.
Yeah.
Because I had not seen that, Karen. I'm happy to see that, and I'll feel a lot better when we see zero as it relates to the allocation towards privates. I just think there's plenty of opportunities in the public space, liquid space, much less expensive overall from a management standpoint. So anyways, I'll leave it at that. I've been talking about it for the last 2 or 3 years at least. So when it eventually cracks and rolls over, we'll have had plenty of lead time.
Sean, and also I think our controller Roy would agree with you on getting the private markets out of our daily funds, because it's such a headache for him to price a daily fund and then to have these private market exposures. And Wah and the team are working. Some things are in the work regarding the private markets. But Wah, I'll turn it over to you to kind of provide an update on it.
I completely agree with you too on that one, because private equity just has different return risk characteristics that don't necessarily fit in the public equity fund. But private real estate's been moved out. Private equity we're letting it sort of just sunset. So as time goes on, we expect to see the allocation to it decrease. And I don't think we have that much in private credit, Karen, in our fixed income fund. And any private we have, I think probably more like a PSP type. Mm-hmm. That serves a different purpose. And I don't know, can I say that we're having those as separate standalone strategies going forward, so that if you do want exposure to private equity, private real estate, private, to PSP, that it could be a choice that you make outside of, the public funds. So that's something that we're looking forward to in 2026 and 2027.
Yeah.
So to clarify on fixed income, the PSPs going to be also removed?
No, we're going to leave it in the fixed income fund. Okay. This is a little bit different than like a private. I mean, it's illiquid like a private strategy, but it's our own internally managed. The fee on it is not any, it's like 30 basis points, and it's literally the fee of what it takes to manage the portfolio, since it is internally managed. This is really our impact portfolio within the fixed income space, where it does provide affordable housing, community development, and disadvantaged areas. So it's the financing of it that's part of the fund. We are launching a standalone PSP portfolio. So
this will stay in the fixed income. It's just you've got a new one if people want a bigger allocation.
Yeah, correct. Like, for instance, I think about some of the larger investors that Dustin's having conversation with, where it may be, hey, one thing we're also finding is a lot of like the Duke Endowment people came to visit us because they love this PSP program and they want to try to replicate it. So it's like, well, instead of replicating it, why don't you just make an investment in our portfolio to get your allocation? So a lot of like nonprofits are increasing the amount that they want to invest in impact. And this is like true impact, especially in their local communities, where this is an ability for them to do that and make those type of commitments without having to bring in the infrastructure to do so. But yeah. And I don't think there is private credit in our fixed income portfolio. It's primarily in the equity space. Here. But Sean, we'll be sure to keep you posted. I mean, this was one of the reasons, we were hearing quite a bit from some of our institutional investors that wanted increased allocations to private markets. And maybe that's because that's what they were being told, is like, well, you're a college endowment, you should have 30% in private markets, which is why we didn't increase it within our own portfolio, but we launched our alternative assets fund that would allow us to continue to provide that asset class to the investors that want a higher allocation without increasing the exposure in our current fund for our investors. Because you're right, it does add additional fees to the portfolio because it is expensive to manage.
It's made for, originally it was made for, really high net worth individuals that could, lock up capital for an extended period of time. They get charged 2 and 12, and essentially the manager would just lever it up, 2 to 3 times. And if the market was doing well, they would take their marks. If the market wasn't doing well, they wouldn't take their marks. And it feels like it's getting super late stage, considering the fact that the administration now is trying to make a push to get it, allocated into defined contribution plans.
Yeah.
And it freaks me out because I don't think people really understand what it is. It's not like, owning a share of Microsoft where you could, get out
it's liquid
if you want to. Yeah, exactly. So I've talked up enough time about it. I'm sorry for kind of bogarting the conversation.
No, that's fine. We and it also highlighted to me that you missed the first part of our conversation when I talked about moving out that private real estate. And you're right. I mean, the funding of it can be 15 years. I mean, we brought on a college in Georgia, and they made commitments in 2020. They bought into a 2023 fund, and they're like trying to figure out, like, do they get out of it? Do they sell it in the secondary market or keep it? Because again, the funding cycle of it, just the oversight, it is challenging, especially for nonprofits. But yeah, this kind of brings us into our U.S. equity fund. Again, one of the things we added, and Richard, I made sure it was included on the slide because I completely forgot to include it last time, and I made sure I call it Richard. You have a lot of Richard's charts and Richard's things in this presentation. So I want to make sure we always add it. But again, it's like, of Kansas's U.S. equity, what is your allocation to mega caps, large caps, small and mid caps, and private equity? So you can see, you have about 44%. So you're over our U.S. equity fund, still a little bit under the benchmark. Large cap stocks, you're, right in line with us and the benchmark. And then small and mid cap stocks, you're kind of right in the middle here. So you're a little overweight the benchmark, but underweight what our U.S. equity fund has. And again, this is as of the end of the year. So these are going to be slightly different when we look at this next quarter. And then you're about 4%. And again, we would expect this to be more around 2% when we move out that private real estate, or I should say, when you see that private real estate on this chart. So again, kind of gives you an idea of where the two funds are and then where exactly your equity portfolio falls.
And maybe a little history for the new members. This is why the committee, once there was a U.S. index fund that would follow the index, we didn't like the large 16% difference to mega caps that was going on. So that's when we decided to introduce the index fund in there to reduce that. I hate to use bets because investment to me isn't betting. Some people think it is, but
I used the word earlier. I'm going to have to talk about that.
Yeah. Anyway, it's investment jargon, I guess, but we didn't like the negative 16% bet. So that's why we came up with our own allocation. And I think going forward, then once everything's done and in place, we may, as a committee, want to review, okay, we've made these changes, and now Wespath changes their allocation. Is our allocation still valid? Do we want to stick with it, which we may, or do we want to fine tune it, or just go back to what Wespath is using?
Yeah, and I think that's definitely a topic that we can continue to have. And I feel like this committee does have a healthy dialogue regarding allocation and positioning. And we have made changes to the portfolio over time because of that. And I know these changes are new. So my guess is probably for the next year, we'll probably just kind of monitor and see how the changes and how the portfolio continues to be positioned. And, if we want to make, lower, because right now you still have your allocation to the U.S. equity fund is higher than the index fund. So I would say your equity portfolio is primarily actively managed, and your balance fund. So, you still have that. It's not as though you made an overweight to the benchmark and underweight to the active stuff. So I think this year we'll, continue to report on it, have that conversation. And again, we did add the international index fund. I know there's not really an appetite at this moment to add it to the portfolio, but again, that could be another thing that we look at to consider if we want to make that allocation. And again, the main difference is going to be, again, active versus passive, but also emerging markets or no emerging markets.
I agree with, we shouldn't even be thinking about it for at least a year.
Yeah.
A year from now would be soon enough, and maybe that might be too quick to reevaluate our allocation.
Yeah.
Aaron?
Yeah.
When I was on the Capers board here in Kansas, they would run what they call the Monte Carlo, and project the performance of these various asset allocations. So I'm new to the board, but does Wespath do anything like that?
Yeah, we did a lot of the Monte Carlo simulations every time we sort of changed the portfolio. So we didn't particularly look at, and this is from the Kansas portfolio level, not from the individual fund level. So anytime we were exploring adding a new fund, removing a fund like we did in the balance fund, we did run the Monte Carlo simulations to kind of look at what the risk return profile was, make sure the portfolio was efficient, and so forth. And I kind of highlighted that a little bit when I was talking about the funds of, hey, you are performing in line with what our long-term expectation was when we built these portfolios for you. And yeah, we have asset class expected returns and risk profiles that we use when we construct client portfolios, and then obviously when we construct our own fund portfolios. We have a whole dedicated team that's led by Raj Khan, who you'll likely see in some of the meetings, and he does a lot of this work with Wah and Frank on the portfolio and client portfolio positioning.
Thank you.
Yeah. I'm not going to spend a lot of time here. Again, one of the things that we are launching is we are going to, one of the big things we hear from our clients is further customization. We want to further customize our portfolio. So for those clients that would like the further customization, we are going to kind of build out and launch, a systematic equity fund, and 100% active equity product. We have the passive product, an active SMID, and then an opportunistic equity fund as well. Again, I'm not foreseeing any changes to your portfolio, but again, these are some options, and we call them the building blocks of what we're going to be launching this year. Again, for those investors that want further customization. And again, down the road, say, Richard, you don't want the Russell 3000, you want the Russell 1000 as your benchmark in your fund or outside your fund. We can do that. We will be able to do that.
Well, I could see this where we've got a very large prospective client that they want to do some custom allocations for a large client. This would fit in. Your average church foundation isn't going to get into this, but if we had a very large client that wanted to specialize some things, this would be great.
Yep, exactly. And that's kind of our thoughts too for our foundation partners. So wanted to just highlight it as an option. I'm not going to spend a lot of time talking about the attribution if it's okay with, I know we talked, it's in the presentation. I know we talked a lot about fund positioning changes, drivers and contributors and detractors. And I know for the sake of time, we are over our hour because Juan and I did spend a lot of time. So I do want to be mindful about that because we did spend quite a bit of time kind of talking about this as we've kind of highlighted throughout. Again, just kind of highlight International Equity Fund. Again, Sean, the private real estate, it has left the building within the portfolio. But again, this is as of the end of the year. So we see it in this slide. And again, this is where a lot of the work's going to be coming in, active versus passive versus allocations within the international fund. Talked about the drivers, fixed income. We did spend a little bit about portfolio positioning and also the drivers of this fund as well. High yield's been one of the strongest performing asset classes, so the overweights helped, as well as the positioning to non-US developed market debt and emerging market debt has been a contributor. As I mentioned, we're not undergoing a deep dive in the fixed income portfolio, but our fixed income team and WA are always evaluating fund positioning and managers. And if we need to make a change in the portfolio, we will, and we will make sure to keep you posted on that.
Karen, just one correction. We're always doing deep dives on our funds.
Deep dive.
We do deep dive.
We do have some market slides in here. I do want to be very cognizant of everyone's time. I will say this hour and 15 minutes really flew by fast. I hope everyone else feels the same way. And again, Dustin and committee, I will take your lead on if you would like for WA to spend any time talking about market stuff, or however you would like for us to proceed, because I do want to be mindful about the time.
The rest of our agenda is not as heavy today, and so I think we would have a little bit of time to go, maybe to 10:30. I'd like you to talk some about some of the things that Dennis lifted up earlier of a lot of global entities are pulling funds, treasuries, selling treasuries. Our inflation is down. However, we're dumping a lot of more money into the system, and so I'm curious about some of those pieces and the future for both equity and fixed income.
Right. I guess on that, it's like some of the bigger themes that we've been seeing when we talk to both our fixed income equity managers. On the fixed income side, what we see is, duration is, once again, it matters. Yields are high enough where it does provide some safety to the fixed income portfolio. And even though credit spreads are historically tight, we still see opportunity there. And this is where active management really matters for us. Our managers are still finding opportunities in certain different credits. So the credit market as a whole is incredibly tight, but there's still pockets of opportunity. And that's where we rely on some of our best-in-class managers to make those decisions. And so we're still overweight to credit in our overall fund. We talked about the underweights of treasuries earlier, and we're still seeing. Sorry, Karen. So there's still opportunity there. And in terms of duration, where most of our managers are about neutral, maybe slightly long, and they are a little bit overweight in terms of the short end of the curve to take advantage of where they think rates are going to fall. There's to the belly of curve, that's done really well, and managers have taken the profit. They're neutral in terms of that intermediate part of the curve. So really where the opportunities are is just being active in credits and focusing on higher quality credits, and where they can still have opportunity. Underweight treasury, we're still, I think, overweight emerging market debt and overweight high yield. But once again, that is where active management really matters for us. Broad high yield benchmarks aren't going to do as well, but very focused allocations to specific high yields is where we're going to benefit. On the equity side, some of what we're seeing is the AI theme. It's still very prevalent, but as I mentioned earlier, the winners and losers, we're going to start seeing a little bit more of who benefits and who doesn't. And we do think that there is going to be a broadening out of who benefits from AI. And so we're going to see opportunities outside the US. We're going to see opportunities in smaller cap. And as it relates to those opportunities outside the US, we're really thinking it's more on the emerging markets. Europe is getting a little squeezed with a lot of geopolitical risk. So there's opportunities in the US and emerging markets, and that's where we're seeing some of that in international. There's another theme of the US market has done really well recently. And do we expect US exceptionalism to continue? I think in the short term, even in the intermediate term, I think we will, because just some of the earnings that the companies in the U.S., they still have quality earnings. So there's the growth is still there in the U.S. And so we do expect that U.S. will continue to outperform, but at the same time, we still think that there is opportunity outside the U.S. And I think you see that in our portfolio. So we still have exposure international. We still think that there's opportunities international to do well, and but U.S. and the AI theme and growth, it's still what most of our managers expect to play out this in 2026. Are there any questions or any thoughts? I think one of the themes too outside the U.S. that we expect to continue is, I think Karen mentioned earlier that international markets have done well. A lot of that is due to, I think, defense names outside the U.S. They've been on a tear. And the returns to some of those names are really strong, but those are also companies that we don't invest in because it's. I don't think we've necessarily seen a period where the European defense names have done this well.
Well, I had a follow-up question on the AI issue, and I know you've addressed that, but my original question was more about, do you see that coming into decision making and strategizing in the investment world?
I think so. Like, we've talked to our managers about how they use AI. I think the whole issue of AI, that there's multiple ways to look at it, but managers are using AI to create more efficiency in how they sort through data. They're not using it to make decisions yet. I don't think that there's still belief that they can do well. We actually did have one manager that I looked at that specifically incorporate AI in how they make decisions. Sad to say, they shut down last year because they weren't getting enough, I guess, adoption in that strategy. So I think it's still new. Managers are still playing with it and see how it could help in their decision-making process. So I do expect that there's probably going to be a little bit more AI in our industry. I just don't know how or how prevalent it will be. Does that address your question, Garth?
I might speak to it as well because I'm in the investment world also, and everything that I've seen, Garth, from an investment standpoint with AI run models, they're terrible. They're just not good yet. There is a lot that AI can do really well right now. One of the things that we use it for, just like was mentioned, is data analysis, sifting through large piles and of data and pulling things to the surface. But it doesn't have the creative capacity yet. It doesn't have the ability to do near what I think everybody thought it was going to have to be able to do at this point in time. And regardless of which, there's still a massive cash burn going on in this environment. Until it gets to a place to where it can actually have the creative functions of a human portfolio manager to be able to look at all the options that are going on around the world, and justify decisions in a way that a human would make it. I just don't think that it's going to be successful yet. Doesn't mean it won't get there. But there's a lot of things that everybody thought it was going to be able to write movies at this point in time, and it can't do that. It can convert songs, it can write its own songs, but not without human prompts. So AI still is kind of an extension. It's just a tool at this point. Just like an Excel spreadsheet is. It's not near as advanced yet as all of the touting has been. Doesn't mean it won't get there, but it does. To me, it's more of a concern at this point in time. I mean, Meta reported last night, and they're essentially projected to burn all of their cash this year. They've traditionally had a large cash pile, as have all of the megas, and They typically do fund buybacks every single quarter. Meta didn't do a single buyback in the fourth quarter. They're burning their cash trying to make this technology work. And, so far it's a long ways from being able to do what they needed to do. And there's such a large bottleneck as it relates to even being able to get these data centers not only built, but powered. In regards to how long it actually takes to build a power plant in the United States, we're years away from some of these new data centers even coming online. So, it's all the talk and all the rage and all the stuff, but it has been for the last 3 or 4 years. And it was mentioned earlier, we only had two of the mags actually outperform the S&P last year. The trade looks very long in the tooth, very mature from where it has been. So, maybe I'm wrong, but right now the price performance and the numbers are showing that, the trade is getting worn out. And I think you'll start to see some other areas, some ancillary areas in the AI trade, people that are suppliers, people that are, building the data centers, people that are power providers that will, start to see some wins off of this as well. But we're years away at best from this thing really, achieving what they think it, was going to achieve here. It's really awesome. It's a great tool. It's not where it needs to be to really take over the marketplace. So,
Lance, did you want to say something? Oh, okay.
I was just going to ask, so if AI is being used more and more for analysis by managers, does that lead to more replication and make it more difficult for managers to have that contrarian, a bet against what everyone else is doing? That's really, when you're talking about AI being good for analysis, does that lead to kind of a generic sense to where managers are all making their decisions based on the same data points?
Okay,
or following the same trends?
I mean, I feel like my take on that is, I feel like we're somewhat there already, just with the availability of data. I don't see most managers really thinking about it differently. It's very rare, and it takes a lot of look at managers to find the one or two or three that are able to take a different view. I think this is why, we've been trying to focus on smaller managers, because some of the bigger managers, especially in equity, they're so focused on not losing assets that they don't want to do anything that's out of the norm in order to outperform. And so that's what we're trying to guard against. And that's why we do dig deep into these managers. And I think maybe AI might increase that at the margins. But I feel like it's already difficult enough to find a really good active manager. And there are people willing to take that chance or to be that different from the rest of the industry.
Walt, could you comment on sort of this extreme rise in gold and silver and what's going on with commodities? What might be driving that? What sort of things should we watch for, be concerned with around that?
On that one, that is a difficult one for me to get my head around, because I look at the price of gold and there's been discussions about it. Yes, there is industrial use for gold, and gold is also an asset that, if you think inflation is going to rise, that you invest in. But from everything that I've read, that I've seen, just the current price of gold isn't justified based on the demand for either jewelry, industrial uses, or inflation expectations. So it's difficult for me to think of this as a justified valuation for gold, given everything else. But we do have, I think, some exposure in our commodities through our inflation protection fund. That's where we have the commodities. We don't see much in terms of our equity funds that people are investing in gold or silver. So on that one, I don't have much more than that. I'm not really sure what's driving the extreme increase in prices on that.
Thank you.
I saw somewhere where a lot of central banks were making large purchases of significant amount of gold, which I trust is because of concerns about the dollar or concerns about geopolitical issues, is driving that. I don't know that. I don't think it's for the purpose of making jewelry. Its purpose as a store of value in a different location, and I think that's driving up a lot of these prices.
And it could be like I was at a conference with someone from the Central Bank of, I think, Switzerland, and they do have 15% of their portfolio in physical gold. So, but I think that's something that they've had, not necessarily an increase in their gold holdings.
I think a lot of it too, Melinda, is it's just the crowd. It's just the crowd. Everybody, you know, they see it going up, it starts to get squeezed, and everybody starts to panic and pile in because, you know, how much exposure do we have in our allocation to physical gold and silver?
Right.
Right.
I mean, I
None.
think that's
it's
where
just-
I go back and say, is it just sort of that the natural things that happen when there's a momentum trade and it becomes irrational with individual investors? Or is there something more broad in the worldwide economy? There's some indication of more unrest concern worldwide. Like that's where we're beginning to really make sure we're watching and focusing and thinking and looking, and you know there's no clarity to it, I think, to your point, Wa. So I just was curious if you had any more insight than we did.
Yeah, I think it started as that, Melinda, and then it just, you know, silver's had a tremendous short against it for decades. And once that stuff starts to go against you, it gets very painful very quickly. And, you know, then it's, you know, how many clients I've had call me about gold and silver in the last 2 weeks. It's just like, to me, it feels like, you know, you're probably getting close to the top when we've held it since last June. And it's kind of late, you know, possibly in this trade as well. But I think it's the dynamic, it's the psychology of humans.
Yeah.
You know, they see something going and they want to be a part of it as well. So they all start running for it at the same time. And watch what happens when they run for the exit at the same time. I mean, silver is due for probably a 20% down day. You know, it's getting in that maybe even beyond that euphoric phase that you're talking about, Melinda. It's kind of wild. It's fun to watch.
Anybody else have questions for Wa and Karen?
This was very helpful. Thank you, Sean. You're going to want to go back through the front part of this presentation. I was very, very, very pleased, very, very, very helpful, very grateful for where the thoroughness with which you've gone through everything and the direction that you're going.
Thanks, Melinda. And I hope you have a speedy recovery with whatever you're dealing with.
Thank you. I had surgery on my hand yesterday.
Oh, gosh. Well, thanks for being here.
Yeah. You know, what else am I going to do?
Yeah. Good point.
Hope you have a blessed day and look forward to seeing you soon. And thank you guys.